The thing that I'm haunted by over all these years is that the level of financial literacy in the US and the UK is where I've seen the data is frighteningly bad. It's not taught well in the schools. It's not taught well in the universities. It's not taught well by the banks nor necessarily the FinTechs. And I think there's a huge opportunity to actually take frameworks that are very, very relevant in how we make decisions and actually do a much better job of getting them out there into the marketplace. And I think that's through employers, that's through FinTechs, that's through banks, that's through our media. People don't understand. I talk to people who are every bit as educated as I am, every bit as smart as me or smarter, who don't understand these concepts because they never really were taught them.
Meet over half of the working world. They are the machine that powers our society, from making your coffee and emptying your garbage to caring for your relatives and delivering your parcels. You might see them as frontline or essential workers, or you might not see them at all. The Invisible Worker podcast explores the financial landscape of our most diligent workforce. We speak to experts in mobility, inclusion, policy, research, and more to find out where the problems are and how we can start to fix them. My name is Emily and I host the Invisible Worker podcast, brought to you by Stream, the world's leading financial well-being provider. And on today's episode, we're talking about financial inclusion and the FinTech innovations that have shaped or are yet to shape the way the working majority interact with their money. I am joined today by Nigel Morris. Welcome, Nigel, to the show.
Thank you, Emily.
Nigel, I know you're a big AI fan, and so I used AI to research this episode.
Did you?
And to background check you, to tell your story.
It's all lies.
It's all lies. Well, I wanted to play a game. So I know some of these things to be truths. I know you are the co-founder and managing partner of QED Investors. But the rest, AI has told me about you. So let's play true or false.
True?
Mm-hmm.
Okay.
Okay. So AI says you were born in Billericay, Essex.
Actually, I was born very close to Billericay in Brentwood, Essex.
In Brentwood, Essex. Okay.
Close.
To a working class Welsh family, according to AI. All right, good. Your father was an army sergeant, and according to AI, you went to 11 different schools.
True.
All right. And you have a bachelor's degree in psychology from North East London Polytechnic.
That's true.
Okay, AI is doing well. An MBA from London Business School, where you're also a fellow.
True.
All right. Moved to Philadelphia, it says in the 1980s. That's quite broad.
I was at LBS and I did a semester at the Wharton School in Philadelphia. And while I was there, I was recruited by a consulting firm. And that was actually 40 years ago now.
40 years ago.
I still listen to myself. Emily, I think I'm 27. And I look at myself in the mirror and I realize that's not really the case. But it was 40 years and it goes past so fast.
40 years, it does fly by. And according to AI, you met Richard Fairbank working at Strategic Planning Associates.
True.
And in 1988 joined Signet Bank to focus on their credit card division.
Mm-hmm.
Great, it's doing really well, in fact. The late 1980s, again, a little bit vague, faced resistance to your expansion ideas. So it motivated you to start your own venture.
In 88, we left consulting and we went to join a regional bank in Richmond, Virginia called Signet Bank that was swallowed up by Nations Bank and I think became B of A in the end. And we went to join there and we ran the credit card business, leveraging off some of the ideas that we developed as strategy consultants.
Yeah.
And then Rich and I took Capital One public in 1994.
Uh-huh.
And then I stayed there for 10 years.
Yeah.
Till 2004, 2005, where we built out what became Capital One. It was an idea then, and we were running a public company and we were learning as we went along. And we went to Capital One, grew dramatically during that time period, and it was great fun.
And then my last AI fact is that you left in 2007 to co-found QED Investors.
Yeah, QED started in 2006, 2007, and now we've been doing venture for, I don't know, nearly 20 years, 18 or so years, and are one of the leading global FinTech platforms. So we only do FinTech, but we'll do it everywhere, and we will do lending and payments, we'll do wealth tech, we will do earned wage access, we will do crypto, but we'll only do FinTech, and we'll do it everywhere in the world. And we've made over 200 investments now, we have over $4 billion under management.
Yeah.
And it's been, for me, a fantastic opportunity to learn a whole different set of skills other than being an operator. during my Capital One days.
Yeah, and what a chance to really be at the forefront of the innovations that are shaping both the industry, but also the way people experience money.
Yeah. And Capital One was, I think, in oh so many ways, Emily, the really first fintech at scale.
Yeah.
And of course, now with the acquisition of Discover, what Rich and I, Fairbank and I had as an idea in 1988 as strategy consultants is now the largest credit card company on the planet.
Yeah.
Which is extraordinary to have been part of that journey. And it's something that we're quite proud of.
And you should be. And I want to reflect on the story of credit cards as a product as a whole. Okay.
Yeah.
The role that Capital One played.
Yeah.
Because it goes back quite a while, right? To the late 1800s when merchants were issuing charge coins, metal charge cards to loyal customers who could effectively settle up later on. It wasn't credit per se, but it allowed them to buy goods and then settle at the end of the month. And in 1914, Western Union issued a metal card. It was a way of keeping track of who their customers were, who they were offering that service to. Kind of time passes and you've got a few innovations in the late 40s or early 50s in the credit card space. Probably Diners Club is the most notable in terms of allowing people to take a card, not just to a store that was issuing the card, but to a variety of restaurants. I think it started off with about 14 restaurants in New York. And it was very much a product for the privileged minority, right? Only very few people could access a credit card. And that was still true when Capital One came along, although there are other innovations. And there's the Fresno drop that's quite famous from 1958 when the precursor to Visa just scattered 60,000
You have
cards.
done your homework.
Yeah, I have done my homework. Scattered 60,000 cards to try to get people to use a bank-issued credit card.
Yeah.
They still weren't super commonplace. And in fact, the real innovation of Capital One, as I understand it, was in enabling the majority to use a credit card when actually there were many people who, for a variety of reasons, were too hard or too complicated or another two word so that the banks wouldn't or couldn't issue a credit card to them.
Yeah, I think there were 2 or 3 interesting innovations that came out of Capital One. One came out of Rich and myself's consulting background, where we'd done research and had worked for the insurance companies.
Yeah.
So we understood that different people of different demography, of different patterns of behavior, would get different prices for their auto insurance.
Sure.
Whereas everybody got the same price. It was actually 19.8% APR and a $20 fee circa 1995 in the US.
Yeah.
So we said, look, why would you have one homogeneous price for people who've got very, very different underlying actuarial risk? So one big breakthrough was to say, look, these customers over here are subsidizing other customers, and these people can't get a credit card at all because their underlying risk would be greater than you could sustain with a 19% APR. So we said we really mechanized, if you like, what we now call risk-based pricing.
Yeah.
And that was one dimension.
And at the time you called it something else, didn't you? Your information-based strategy?
Well, the information-based strategy was the use of data to be able to predict underlying risk.
Uh-huh.
And that same information-based strategy led to the second primary innovation, which was the ability to now leverage direct marketing channels. Hitherto, people walked into bank branches and said, can I have a credit card, please? And we saw that direct mail allowed you to surgically target people without having to have a branch infrastructure. Of course, Capital One did not have any branch infrastructure, hence it was the first real fintech. We went from direct mail to telemarketing, and then around the 2000s, we started to leverage digital technology to do marketing. But the information-based strategy is to leverage lots of data, one, and two, to experiment and test your way into figuring out how to optimize what kind of product works for what kinds of customer at what kind of time. So it was the whole mechanization of data and information in a business that we said was, in many ways, a giant experiment. And the rule of the game was to figure out how to optimize.
So I like to say that I've been in FinTech since before FinTech was a word. I've got more than 2 decades in it, but you've been building FinTech since before FinTech was a word.
Yeah, in some ways, yeah. To me, it's about innovation, and it's about recognizing how to develop product market fit where you can meet a customer's need where it is. And I think that one of the challenges of mainstream banking today is that it's not doing that. It's very much saying, I have a product, and if you come into my branch, I'll sell you this product. Rather than, recognizing that people are very different. They're different by geography, by demography, by stage of life, by their needs and wants. And how do we tailor an individual product to meet those needs?
Yeah, very much so. And I want to talk more about banks, but actually, first, I want to pull back a little bit and I want to dig into your psychology background, if that's okay. And I listened to an interview you did, and you spoke about you started off with the psychology degree, and then as time passed, you became very much an empiricist. But I want to bring you back to your roots, and I want to talk a little bit about the double-edged sword of fintech innovation and financial inclusion and extending products to the masses, and specifically the psychology of digital payments and debt. I find this fascinating. As you know, credit cards are now mainstream, largely thanks to Capital One. 80% of American adults have at least one credit card. It's still not totally evenly distributed, so there's an income kind of distribution curve there, where if you are earning below 25,000, it's a little less than half. So there's still work to be done in terms of full inclusion. There's some really interesting research into behavioral economics and behavioral psychology. And you probably know what I'm getting at, things like the pain of paying. So when you had to pull cash out of your wallet to make a payment, you felt that almost physically, and you could see your wallet shrink in size. Whereas a credit card tap separates the pain of paying from the act of consumption, even more so with mobile payments, so with digital wallets. Yeah. To the point where a June 2025 journal article is now saying it's causal, right? Mobile payments are causal in terms of debt. You are more likely to accrue debt when you take the friction out of this customer journey. And it's also the kind of mental accounting of money, where again, if you are pulling dollars out to pay for something, you can do that adding up, whereas you're not really thinking about it and you're tapping and paying in a digital way. It doesn't feel as real to you. And to an extent, you use your credit card limit as your guidance, and it can create this illusion of affluence, it's described as. I'm curious as to your reflections with your psychology background in terms of, have we gone too far in terms of making things frictionless?
I've always loved the intersection of economics and psychology, which is behavioral economics. Yeah. And how so much of economics is, let's assume man or woman in access to all information and is entirely rational. Yeah. And in which case they will do X or Y. Yeah. And that assumption is so bogus, because people don't behave rationally. And there's so much evidence of that. And you're reflecting on a particular piece of it where physically handling dollar bills or pound notes, when you take them out of your wallet, out of your purse, you feel like I'm now losing something. Whereas if a series of ones and zeros change on your mobile device, it doesn't feel the same. Yeah. So to me, there's an inevitability about where financial services are going. And one is that so many financial institutions confuse inertia and loyalty. In that, but just because somebody sticks around with your bank doesn't mean necessarily that you're going to have a high net promoter score. And it doesn't necessarily mean that you're offering a great service. It just means that person isn't moving, and that my person might not be moving for a whole host of reasons. But they might not think it's worth it for $10. And we'll come back to AI and the role that agentic AI might play. We are coming back to that, yeah. Two, it might be that they see it as difficult to move. And as we move to more and more open banking, we'll see that friction will go down. So one phenomenon is friction is going to fall into the future. And we can't stop that. That is King Canute trying to stop the waves from coming in. That's going to continue. And I think what the challenge that we have as being active members of the community is to arm people with the heuristics and the frameworks and the education to understand how financial service products work and to make the right decisions for themselves and their families. And the thing that I'm haunted by over all these years is that the level of financial literacy in the US and the UK, is where I've seen the data, is frighteningly bad. It's not taught well in the schools. It's not taught well in the universities. It's not taught well by the banks, nor necessarily the FinTechs. And I think there's a huge opportunity to actually take frameworks that are very, very relevant in how we make decisions and actually do a much better job of getting them out there into the marketplace. And I think that's through employers, that's through FinTechs, that's through banks, that's through our media. And I think there's such an opportunity to do that. People don't understand returns on investment. They don't understand how long it takes to get paid back for a decision you make. They don't understand how interest rates work. For me, as I've lived this all my life, it's second nature. I talk to people who are every bit as educated as I am, every bit as smart as me or smarter, who don't understand these concepts because they never really were taught them. So I think that in the end game of frictionless society around financial services, where consumers will have the opportunity to unbundle their financial service relationships. So they'll have their checking account here, they'll have their credit card here, they'll have their IRA here, they'll have their mortgage here, their auto finance here, and they will look to cherry pick the products that they want with a particular provider. And it'll be much harder for the provider to bundle those relationships, and the individual or the small business will only allow the bundling in the event that they're offering a superior service. With that, I think with the right kind of heuristics and education, I think people can make the right decisions for themselves.
So you're an optimist. You believe that actually that unbundling will happen and people can cherry pick the best of.
It's happening.
It's happening now.
Yeah.
I have a challenge on the...
But I don't know if that's optimistic or not. I think it's...
I think it's optimistic, right? I think it's optimistic to believe that people can choose the best and can choose the best for their circumstances. Not as in people's ability to choose, but as in that future is coming for people and that everybody can access that future. The challenge on the education piece, ever so slightly, I think some of the concepts you raised, I agree, are complex and people aren't taught them. But from the work that I do and from what I see, it's really the basics in terms of people understand the basic decisions they should be making, but they still often don't make them. And that's where some of the behavioral economic comes in. And I'm talking about things like everybody can articulate that they should save some money. They should have a rainy day fund set aside. Everybody can articulate that they should spend less than they earn. And yet most Americans spend more than they earn, right? 53% spend more than they earn, according to the latest research from the Financial Health Network. That's not an education problem. That's an inclusion problem, or that's a tooling problem, or that's a something else problem. But that to me isn't the heart of it. Going a bit further and saying, how do I optimize my money? Potentially an education problem, but I would also argue that the tooling should be designed to create those outcomes for people. So how do you align incentives so that we get there? Where as FinTechs or as banking providers or as anybody else in this ecosystem, it's in our best interest for people to have good outcomes.
Yeah, I think it's a really interesting debate. It may be a grey area in between, Emily. When I have been involved in research where you can lay out to an individual, when you're 20, if you start putting money into a tax-deferred vehicle and that money can compound on a pre-tax basis, and all you have to do is not touch it and wait until you're 50 or 60 or 70, and the economics of it are this compelling. Yeah. Compounding is such a powerful force, right? Yeah. When people see that and they see how it changes the shape of their sort of economic frameworks, I think people can have eureka events where they go, oh my goodness, I didn't realize how big that could be. And all I have to do is put a small amount in every month. And I think that we can do a better job of explaining and articulating that and framing it up for people who are not necessarily incredibly quantitative and or feel uncomfortable with the mathematics of it. So I think that's true. But I appreciate what you're saying, that people live for today in oh so many ways and make decisions today that are optimal, and maybe realizing that it's going to have a deleterious effect down the road. I don't really know how you can tackle that. Maybe there are point systems, maybe there are incentive systems. If you go to behavioral economics again, there are token economy type structures where you can offer rewards to encourage people to do things that are in their own interest. I think that can make some sense. But we are going to see a world where individuals and small businesses are going to have much greater decision degrees of freedom in a more frictionless world. And I think it's going to be down to people making the right decisions and what those frameworks are. Now, when you brought it up earlier, it'll be interesting how the AI robots start to play. Because the AI robot will look to optimize, if you program it correctly, for the long run. So maybe the AI robot, as in agentic AI, will make the long-term decisions for the individual, even if the individual will want to do things that are more short-term oriented.
Yeah, so there's two things I would add to that. One is here in the UK, the government back in 2012 began rolling out automatic enrollment into workplace pensions.
I saw that, and that's fantastic.
It's fantastic. It's based off from research out of Harvard University, and it has completely changed the shape of retirement savings. Because again, people knew they ought to be saving, but found it very difficult to make that choice.
So the default option was to save unless you opt out, rather than the other way around.
Yeah, absolutely.
Yeah. So that's 60% in the middle who ordinarily would have not saved are now saving.
They're now saving.
Fundamentally best in their interest, yes.
And it puts the burden of action on those who are more financially capable. So if you were already saving, perhaps you would choose to opt out. Whereas if you do nothing, That's a positive example of friction. I also want to talk about Stream ever so briefly, and I don't normally talk about Stream on this podcast, but in my day job at Stream, and Stream is in the QED portfolio, a lot of the work that we do is helping people build a relationship with their money. So just showing them the value of their earnings, helping them save those earnings, helping them access those earnings when they want to. And that positive relationship with money creates a really phenomenal behavior change that is very unintuitive, where people who see their pay, who access their pay on demand, in the main respond by spending less. And that is not the outcome you expect to see when you open up pay to people, especially people who are lower income workers. And it's almost back to this friction point, or this sort of physical relation point, where you can start to connect the feeling of work in your body and in your brain with how many dollars you're seeing that you've earned that day. And you become much more careful with those dollars when you understand the physical or emotional or mental effort you've just outlaid to earn them.
Isn't that interesting? I would have hypothesized, hearing that, Emily, that it comes down to control.
Control is a big part.
Right. So when the employer has got my money that I have already earned, I don't feel like it's mine. If I know it's in my bank account and I own that bank account, and that digital representation is mine, and I'm checking it how many times a day? I don't know what the average Stream customer checks.
Yeah, every day.
Her money every day. I get this tight correlation between work and money, and I feel like I'm in control and I own it. And I think that might be part of what's happening here. But I'm encouraged that it leads to a behavioral change.
Yeah. Control is a big part of it, absolutely. When you read what people describe, often it's, I now understand the value of my work, so I'm more careful. This is language we hear from people. I'm more careful now.
Yeah.
I've changed my spending because I can feel how hard I worked for that money. And again, I'm better aware of it and I'm paying attention to it. So for me, coming back to that question of education, and I don't mean to harp on about it, but I have strong opinions here. For me, a lot of education is contextual information.
Yes, sir.
Showing somebody what's actually true about their finances today and the impact of the decisions they're going to make is really powerful. And I think we're actually violently agreeing here.
Yeah, I want to point to something that some of our FinTechs have done, which I really laud. And that is that if you ask the average person on the street, what is a credit bureau and how does it work? They really don't have a great deal of understanding or knowledge. The scores between 500 and 800. And there are 3 bureaus, Equifax, TransUnion, and Experian. These are things that we know. But the average person on the street does not really understand that. QED invested in Credit Karma in the US all those years ago, 12 years ago, which has now 130 million customers. And what Karma did is that it democratized access to your own data. Experian, Equifax, and TransUnion had data on you that they were required to give you access to if you asked for it, but it came to you in a format that was incoherent. It was impossible to understand it. Karma took that data, distilled it into a score, the FICO score, and variations on that, and then gave you access to it and said, if you do X or Y, your score will improve by this amount, which behaviorally will lead to lower price debt for you. So they joined the dots up for you. And then in the UK, 10 years ago now, we started ClearScore. And ClearScore took that basic model and now has over 20 million customers, UK, Canada, New Zealand, Australia, South Africa, and has built that same model out. Democratizing access and explaining what the data is and how it works, again, puts you in control and empowers you to be able to make trade-offs. And I think that's really powerful. And what I've tried to do with the FinTechs that I work with is say we have a responsibility to educate and articulate. And it doesn't cost that much. One particular portfolio company put together a whole series of 30-second or 45-second long stick figure explanations of how things work that are very fundamental building blocks of financial service. What is an interest rate and how does it work? You borrow $10 and the interest rate is 15%. Therefore, at the end of a year, it'll be 15% of 100 plus the compounding. And it seems strangely Mickey Mouse in some ways, but these are fundamental building blocks. I think a lot of the people who are out there trying to earn a living, trying to get through their day, making sure that the kids are getting fed and that they're paying the utility bill, that we lose sight of. And I think this is such an opportunity and a responsibility for financial service providers to look to make that data and that education available. Now, the challenge is getting people to do it.
Yes.
Right. But what we found with lending businesses, for example, if I say to you, As part of the application process, we want you to hear a bunch of things that can explain how the product works in stick figure language.
Yeah.
Many people will click on it and look at it and learn about it and watch it. And I think that's very powerful. If you just have a website and say, hey, we've got a bunch of education materials, come and have a look.
Yeah, no one's going to do it.
Everybody's too busy. Everybody's got too much on their mind.
Yeah, absolutely. I can hear how strongly you feel about this. I'm curious, back in your Capital One days, was this a priority for you, or is this something that you've developed over the years?
I think Capital One, relative to the banks, was democratized access in ways others didn't. 40% of America has real difficulty getting a credit card. So if we take people with a FICO score under 650, they don't usually have that much money.
Yeah.
So the deposits aren't worth anything to the bank. Banks got largely a fixed distribution system called bank branches. Banks don't want to lend money to this population. So it's been the FinTechs. It's in the US, it's been Chime and Albert and Current. Here it's Monzo and Zopa who have stepped, and Revolut will focus on partly that population. And I think it's the FinTechs that have stepped into that part of the population that the banks won't serve. But yeah, I think that there's a real responsibility here. And that our political apparatus talks a lot about this, talks about inclusion and talks about education, but really talks about it a lot, but doesn't really do very much about it. One itch that I will try to scratch before I call it a day, Emily, will be to look to how we can really, on a mass scale, democratize access to financial service education. And in a way where you build a brand and a household name and people go to it to understand these concepts.
All right, can we flip that thinking for a moment? And I love that ambition. And also, it is true to say that those who are building FinTechs, those who are operating FinTechs, those who are running banks, are not representative of the working majority, right? They tend to earn salaries that are much higher than the median. They tend to come from different educational backgrounds. So how do we educate those who are leading to pull in the lived experience of those who they're trying to reach, right?
You've got to lead them, Emily. They're so busy building their businesses. They're so busy focusing on making sure they hit their earnings. They're so busy being driven by the forces that exist in a free market capitalist system.
Yeah.
It's very hard to get them to do it out of altruism or some sort of philosophical perspective. So I think you have to lead them and you have to say, this is really important and here's why it's important. And here are the tools. Here are the things that we can provide to you so you can just plug and play rather than you have to go off and develop it.
Yeah.
Now, in the long run, I think that if you look at the Chimes and you look at the new banks of this world, these challenger banks, the Monzos, they are much more focused on meeting a customer's needs and getting fabulous net promoter scores, not because it's altruism particularly, but because it leads to better stickiness and lower attrition and better net present value per customer. And part of that should be the equation of we're going to look after this customer and she makes the right decisions and give her everything she needs to make those decisions.
Well, again, if you're an optimist, and I am, it's the long-term sustainability.
We are agreeing on that.
Yeah. If you want to build a sustainable business, as in one that will still be here in years to come, you have to look after your customers.
Well, and I think with lending, we were flirting with this. People have a hope springs eternal model. I'll take the money today, I will take advantage of that money today, and I'll figure out how to pay it back down the road. And the rapacious payday lending apparatus makes huge amounts of money on that phenomenon. And that's a place where regulation can play a role in the really egregious behaviors that exist. But even more than that, the regulatory climate can support more FinTechs who will do that in a much more responsible way, because the banks aren't going to focus on that population. And the level of financial awareness is so low, there's really so much value that can be added.
Yeah, and actually coming back to Chime, and Chime is relevant because at the time of filming, they very recently IPO'd.
They did, yeah.
They've managed to serve a base of people who are not mainstream. And actually they've done it, again, as a wealthy FinTech with very high salaries in amongst people who work for Chime. So they've managed to do that work and that others haven't. And I think it's ironic that we talk about banks as mainstream because they've never served the mainstream.
Except they're on the high street.
Yes.
Right? And people pass them every day. But Chime is an unusual model, Emily, because it's largely a payment platform and a tech platform. Because debit interchange is so much higher in the US than it is anywhere else in the world, you can build a business that makes economic sense with just a debit card. In the UK, that's much harder. If we look at one of the household names of Monzo, Monzo could not build a business based on debit interchange.
Yeah.
They had to build a lending business alongside it. And I think that's a real differentiator. But I think you are quite right. The people who are running these financial institutions, by and large, do not come from the socioeconomic class of the people that they are serving, particularly if they're in the fintech world.
Yeah.
But if we go back and look at the 220 investments that QED has made, I have not gone back and done this analysis. I would bet that 40% of the founder groups are immigrants in the US in some form or fashion, and often have faced significant hardship and have seen their immigrant families grow up. Now, they're invariably gifted in certain ways and have gone to great colleges. But I think that coming from an immigrant mindset, particularly in the United States, has been very powerful in using the fintech on inclusion.
Yeah. It's the American dream.
It's the American dream. Yeah.
On that note, I think we need to wrap up, Nigel. I have one closing question I want to ask you, which I always ask every guest on the Invisible Worker podcast, which is, the theme is the invisible worker, the financial lives of the working majority. What is the one thing you wish many more people knew about the financial lives of this invisible worker? One last thought for the day.
Yeah, I think that it's how big it is, Emily. This is not 5 or 10% of a population. This is a third or 40% of the population. And I think it's screaming for help. These are people who are living hand to mouth, live paycheck to paycheck, who are fighting to bring their families up and fighting to pay the rent. And they feel like the system is stacked against them. And I think that the more we can shine a light, a torch on these people, understand what they are going through, and look for the community and system as a whole to support them, that's a powerful thing. That's why.
Brilliant. Thank you very much, Nigel Morris.
Thank you.
Before you go, make sure you stay in touch. Please subscribe to the Invisible Worker podcast on Apple Podcasts, Spotify, or wherever you go to listen. That way you can follow along as we release new episodes. Thanks again, and see you soon.